Every commercial ship that sails is insured. Every container of cargo that crosses an ocean is insured. And the way that insurance is priced, who decides what a route is worth, what a risk costs, what a war zone means for a premium, is almost entirely invisible to everyone outside the industry. And yet, marine insurance is one of the most powerful forces shaping global trade. It determines which routes ships will sail. It sets the price floor for what cargo movements cost. And in moments of crisis, a war, a choke point blockage, a rogue wave, it is the marine insurance market that decides within hours whether a trade lane stays open or effectively closes. This is how it works, and why it matters far more than its obscurity suggests. I'm the host of Supply Chain Daily. In previous episodes, I've mentioned insurance markets when explaining disruptions, the Red Sea crisis, the Strait of Malacca, the Panama Canal. But I kept referring to this system without fully explaining it. Today, I want to fix that. Marine insurance is one of the oldest financial systems in the world and one of the least understood. Let me take you inside it. The global marine insurance market is worth approximately $35 billion in annual premiums. That covers hull and machinery insurance, the ship itself, cargo insurance, and liability coverage. It is not the largest insurance market in the world, but it is arguably the one with the most direct and immediate influence over the physical movement of goods. Here is the mechanism. Without insurance, ships cannot operate commercially. Ship finance requires insurance as a condition of the loan. Port entry often requires proof of liability coverage. Charterers require hull insurance before they will put cargo on a vessel. The insurance requirement is not regulatory background noise. It is a hard constraint. A ship that loses its insurance coverage can, in practical terms, stop operating within days. This means that when the insurance market decides a route is a war risk zone, or that a vessel class poses unacceptable liability, or that a particular flag state's vessels will face higher premiums, those decisions have immediate commercial consequences. They are not opinions, they are prices, and prices change behavior. The Red Sea crisis we covered in a previous episode, the thing that actually forced most carriers to reroute around the Cape was not the missile threat itself. It was the war risk premiums. When the cost of insuring a transit became prohibitive, the route effectively closed to mainstream commercial shipping, even before any carrier made an official announcement. Marine insurance has one of the longest institutional histories of any financial market. It traces directly to a coffee house on Tower Street in London, run by Edward Lloyd from around 1686. Merchants, ship owners, and the men who would underwrite risks on their voyages gathered there because Lloyd kept shipping news and posted information that was useful to anyone with a stake in a voyage. The practice of underwriting, where an individual would sign their name under a risk description and accept a defined share of the loss if the ship sank, developed organically in that coffee house. By the mid-18th century, Lloyd's had become so central to marine insurance that it formalized into an institution. Today, Lloyd's of London is not a company, but a market, a collection of syndicates, each of which can write insurance, backed by capital from investors called names. Alongside Lloyd's, the other critical institution in marine insurance is the P&I Club system. P&I stands for Protection and Indemnity, liability coverage for third-party claims, crew welfare, pollution, and cargo damage. P&I clubs are mutual insurers. Ship owners pool their risks, and when one club member has a claim, the others share the cost. The international group of P&I clubs collectively covers around 90% of the world's ocean-going tonnage. If your vessel is in the international group, you have access to pooling arrangements that make even catastrophic losses manageable. If you're outside it, as vessels in the dark fleet operating Russian oil largely are, you are on your own. There are three specific mechanisms through which marine insurance shapes where ships go and what they carry. Understanding these three explains a large part of how global trade actually functions. The first is war risk designation. The Lloyd's Joint War Committee, a standing committee of underwriters, publishes a list of areas where vessels face elevated war risk. When an area is added to the list, marine insurers are required to give notice before covering a transit, typically 7 days. That notice requirement creates a window where coverage is uncertain, which means carriers and charterers are reluctant to commit. When war risk premiums then spike to reflect the new designation, the economics of certain routes change immediately. This is exactly what happened with the Red Sea. The JWC listed the area, notice periods were invoked, premiums multiplied, and within days, the world's largest container lines had announced rerouting decisions that would have taken months to negotiate in any other commercial context. The insurance market moved first. The operational decisions followed. The second mechanism is general average. This is an ancient maritime legal principle, older than Lloyd's, that holds all parties sharing a maritime venture responsible for losses incurred to save the voyage. If a captain has to jettison cargo in an emergency, or if the ship's engine needs major repair mid-voyage, all cargo owners contribute proportionally to the cost. The principle sounds archaic. In practice, when a large vessel has a significant incident, general average declarations can freeze thousands of cargo shipments for months while adjusters calculate who owes what. Understanding GA is essential for anyone insuring high-value cargo and for anyone trying to understand why their goods are held after an incident that didn't directly involve their container. The third mechanism is P&I club withdrawal. When a club withdraws coverage from a vessel because of flag state concerns, age, maintenance records, or sanctions compliance issues, the vessel becomes commercially radioactive almost overnight. No charterer will put cargo on an uninsured hull. No port will guarantee entry. This is the structural mechanism by which the industry maintains minimum standards on vessel safety and compliance. It's imperfect, the dark fleet's existence proves that, but it works for the mainstream market. Inside the supply chain, dealing with marine insurance is not something most practitioners think about day to day, until something goes wrong. Then it becomes the most important conversation you're having. The general average mechanism is the one that surprises cargo owners most often. If you've never been caught in a GA declaration, the idea that your perfectly undamaged goods could be held hostage to a financial adjustment involving everyone else on the ship feels deeply unfair. And the reality is, without adequate cargo insurance of your own, not just the carrier's insurance, but your own cargo policy, you may have very limited recourse and very little leverage. The other thing practitioners learn is that marine insurance pricing is genuinely informative. When war risk premiums on a route start moving, even modestly before any official announcement or news coverage, it usually means that underwriters are seeing something in the market intelligence they have access to. Insurance pricing is a leading indicator of risk, not a lagging one. The industry has been saying this for years. The Red Sea crisis illustrated it for everyone else. The dark fleet's existence outside the conventional P&I system is the issue that marine insurance practitioners are most focused on right now. When a tanker carrying Russian oil and covered only by a Russian state insurance entity runs aground or causes a spill in the Turkish Straits or the North Sea, the question of who pays for the environmental damage is genuinely unresolved. The answer, in practice, is likely to be taxpayers, because the conventional system that would handle it has been deliberately bypassed. This is Supply Chain Daily, the systems of global trade, explained from inside the industry. New video every Thursday and Saturday. Subscribe if this kind of depth is useful to you. If you work in marine insurance, maritime law, or risk management, your perspective is particularly valuable here. Drop it in the comments. Until next time, keep an eye on what's moving.